There are only two time frames that matter to a trader who wishes to move with purpose instead of confusion. The market never set out to mislead you, but the crowd will. Indicators will. Your own impulses will. The only solution is discipline, clarity, and a plan rooted in time frames that reveal both the forest and the tree. That plan begins with the 4-hour chart and the 1-hour chart. Working together, each holding a truth the other does not. Most traders scatter their attention across a dozen charts, believing more information means better decisions. It never has. It never will. The market rewards conviction, not clutter. A man who follows 10 time frames has no anchor at all. A man who follows 2 with precision stands a chance. Whenever I look at a market, I start from a vantage point high enough to see the direction that matters. The 4-hour chart is that vantage point. It clears away the noise that infects smaller time frames. It shows the dominant trend, the path along which capital is quietly moving. Money flows slowly, deliberately. The big players that shape the trend cannot hide for long on the 4-hour. Their footprints appear in swings, in retests that hold, in momentum shifts that signal the easy path forward. Without that reference point, a trader becomes a leaf in the wind, forced to react to every gust. I learned this lesson the hard way. When I first began trading, I believed every tick mattered. Every fluctuation felt like a revelation. I would jump in and out with speed and excitement, convinced that activity equaled opportunity. What I earned was chaos, exhaustion, and unnecessary losses. Only when I committed to observing before acting did I see the truth that had been hidden from me. The market is not measured in minutes. It is measured in swings, in cycles, in phases of accumulation and distribution. To identify those phases, you need a higher frame that breathes slowly enough to expose them. The 4-hour chart is the perfect tool for that purpose. On the 4-hour, you must train your eye to observe structure before anything else. Where are the higher highs and higher lows if the trend is up? Where are the lower highs and lower lows if the trend is down? If neither side is dominant, money is undecided, and the best trade may be no trade at all. Most traders refuse to accept that standing aside is a decision. They crave action. But the market punishes impatience without mercy. There's no more fatal mistake than trading during indecision and convincing yourself you are early to a move that hasn't begun. Look also at momentum on the 4-hour. Does price pull back shallowly and resume with force? That's strength. Does it struggle upward on weak candles, only to roll over sharply? That's exhaustion. One has to observe these signs with detachment, without projecting hope or fear. A trader who has predetermined what he wants to see will be blind to what is actually there. But the 4-hour alone is not enough. It sets the bias, it chooses the side, but execution demands precision. The longer time frame gives the direction, the shorter gives the timing. That is where the 1-hour chart enters. The 1-hour chart translates the broad trend into actionable entries and measured risk. It is the battlefield where conviction is tested. Too long a time frame and you wait forever. Too short and you drown in noise. The 1-hour chart is the balance point. Many traders do not know how to bridge these two frames. They look at the 4-hour, conclude the market is trending upward, and buy impulsively on the next candle they see. They ignore support levels, liquidity zones, and pullback structures. They buy with no concept of where the trend breathes. The 4-hour tells you whose side to align with. The 1-hour tells you where to quietly join the winning army without drawing fire. When you've identified the direction on the 4-hour, your next task is to wait, not chase, not predict. Wait for the market to give you the chance to risk small and aim large. Patience is not passive. It is the discipline to sit still while others exhaust themselves. Look for price to retrace into a level respected before, a previous high that became a low, a broken resistance revisited. The 1-hour chart exposes these turns in ways the 4-hour smooths over. This is not a race. It is stalking a target. Every good trade is based on structure. But structure is more than a line drawn on a chart. It's the human behavior repeated beneath it. People buy at levels that feel safe because they bought there before and survived. People sell at levels where their fears previously overwhelmed them. Until something shifts in mass psychology, those habits repeat. If you understand that the chart is a reflection of human nature, not numbers, you are already ahead of the crowd. On the 1 hour, watch how price reacts at your planned level. Does it form hesitation, a slowdown in selling during a pullback? Do you see candles with long wicks rejecting the level? Does volume expand as price bounces away in the direction of the 4-hour trend? These are clues that the big money is active and the retail trader is uncertain. That uncertainty is your advantage. You are not trying to forecast the entire journey of a move. You are trying to catch a portion of a swing that already has a wind at its back. The reason these two time frames work so effectively together is because they eliminate the confusion that kills most traders. A trader watching too small a chart is hostage to noise. A trader relying solely on a large chart is late to every move. When both align, a 4-hour trend confirmed, and a 1-hour entry structure forming, your odds shift dramatically. You are not fighting the tide, you are moving with it. Still, even with this clarity, traders sabotage themselves. They enter too early because they fear missing out. They enter too late because they wait for confirmation that removes the opportunity. They hesitate, then overcompensate. All of these errors stem from the same source: emotion. Markets feed on emotion like wolves feed on the weak. Prices do not move randomly. They move along the path of maximum pain, flushing out the impatient before rewarding the disciplined. To master these frames, you must accept that losses are not failures. A trader who refuses to lose will eventually lose everything. You measure success not by how often you win, but by how well you handle the inevitable losses. If you stick to the 4-hour bias and respect the 1-hour structure, your losses become controlled, small, and forgettable. The winners become meaningful. That is the formula for long-term survival. Persistence without discipline is foolishness. Discipline without persistence is wasted potential. Both must exist together. Hold a vision of your best self as a trader. That self does not chase price. That self does not switch direction randomly. That self follows a process rooted in clarity. Set the bias on the 4-hour. Execute on the 1-hour. Manage risk with the respect due a dangerous profession. The market does not owe you profit. It merely offers opportunity. Whether you seize it or squander it is a matter of training your eye and tempering your impulses. The curious thing about mastering fewer time frames is that it feels like a narrowing of information, when in truth it expands understanding. By focusing deeply instead of widely, you begin to see patterns repeat. You learn that after a large trend move, the market rests. You start to anticipate pullbacks not with fear, but with readiness. You come to recognize that trends bend before they break, and that reversal signs appear first on the lower time frame, but must be confirmed by the higher. It's a dance between compression and expansion, and these two time frames reveal it clearly. Remember always that markets move in waves. The 4-hour reveals the tide. The 1-hour reveals the swell beneath the surface. When both point in the same direction, you have simplicity. Trading is not meant to be complicated. The complexity is an illusion, created by traders who believe effort must equal reward. The market requires none of your complexity. It responds only to your discipline. When a trader truly understands the interplay between these two time frames, his entire approach changes. He stops treating every fluctuation as a signal and starts recognizing the broader rhythm of price. There is a sense of calm that replaces the frantic energy that drives most participants. You are no longer reacting to every candle, every spike, every manufactured surge designed to bait the inexperienced. You are observing, tracking, calculating, and then acting only when conditions align. You trade less, but you earn more. You risk less, and your confidence grows not because you are certain of victory, but because you have a process that keeps you on the right side more often than not. The 4-hour chart trains you to see the market's intent. It is slow enough to reveal the path being carved by institutions, funds, and the calculations of those with deeper pockets and longer horizons. If you can identify where they are accumulating positions, you will understand why the market rises, even when the news seems grim. If you can pinpoint where they are distributing, you will recognize the early signs of a decline before the crowd panics. The 1-hour chart lets you slip into their wake, unnoticed, allowing their momentum to carry you without the burden of predicting the future. You become a passenger on a ship whose direction is already set. Yet even armed with this clarity, traders face another battle, the war within themselves. The market is relentless, but it is neutral. The trader, however, is emotional, inconsistent, and prone to self-sabotage. The greatest challenge is not the chart, but the habits that have taken root through repetition. The urge to jump early, the refusal to accept a small loss, the compulsion to add to a losing trade. These are the vices that separate those who stay from those who vanish. The wisdom of the 4-hour and 1-hour system is that it forces you to build discipline naturally. You cannot chase the market because the 4-hour trend only shifts meaningfully after hours or days of movement. You cannot overtrade because the 1-hour structure gives limited quality entries. You cannot deny risk because the structure shows clearly where your trade thesis fails. If you stick to these rules, your trading becomes an exercise in patience and clear thinking instead of adrenaline and improvisation. A trader must learn to treat silence as strategy. There will be days when the 4-hour chart is undecided, compressing into a range. There will be hours when the 1-hour forms no pullback worth risking capital on. Those are not lost days. They are foundational days. They train your restraint. They conserve your capital. Every period without opportunity is preparing the next one. The worst traders force trades during these stretches, confusing effort with progress. The best sit calmly, knowing that the market rewards readiness, not restlessness. When markets trend strongly, the two time frames work together as a compass. You spot the direction and follow it like a river downhill. But markets do not trend forever. Sooner or later, the 4-hour will begin to shift. You may first notice the change on the 1-hour. Pullbacks deepen, bounces weaken, levels that once held firmly begin to crack. This is the whisper before the shout. Traders who ignore that whisper will be caught by the reversal and suffer the consequences. Those who pay attention to both frames will see the warning signs, tighten their stops, protect profits, and make the hardest move in trading getting out while you still look smart. Reversals are the graveyard of traders who fall in love with a direction. A trend does not send a telegram announcing its end. It erodes slowly, like a rope fraying strand by strand. A higher low fails to form. A fresh high is shallow and quickly retraced. The 4-hour begins to flatten. The 1-hour starts printing lower lows. This is not the time to invent excuses. The market is speaking plainly if you know how to listen. Respect the message. Step aside. Let the dust settle. When a new direction emerges, the cycle starts anew. This approach prevents the dramatic losses that wipe out accounts. It keeps you aligned with the market instead of tied to outdated opinions. The market is never wrong. Traders simply stay wrong longer than they can afford. Your job is not to be right. It is to be aligned with what is happening now. With this system, entries become systematic rather than emotional. You identify the trend on the 4-hour. You wait for the pullback on the 1-hour. You set a stop where the structure invalidates your idea. You aim for targets defined by previous swing highs or lows. There is no need for prediction. You follow price as it reveals its intention. There is no need for haste. When you trade only in the direction of strength and avoid counter-trend impulses, your win rate improves not because you predict better, but because you stop betting against the river. Money management remains the backbone of survival. A trader who risks recklessly has already lost, whether he realizes it or not. The market is a long game. One can navigate it successfully with modest position size and clarity. Large size will amplify every emotion and distort every decision. A trader risking too much will see ghosts in every candle. The market senses weakness and devours it. With disciplined risk, losses become tuition instead of tragedy. You are free to execute the strategy consistently, without fear paralyzing your judgment. If you stay committed long enough, you will experience the most dangerous season of a trading career, the early streak of success. A few well-timed trades in the direction of the 4-hour trend will make you believe you've cracked the code. You will feel invincible. You will imagine scaling aggressively. This is the moment when the market tests your character more than your skill. Will you abandon the method that got you here? Will you trade without waiting for pullbacks? Will you forget that the same market that rewards can also humble? The market does not tolerate arrogance, not even for a day. Failure teaches lessons no victory ever could. But failure with discipline is survivable. Failure with recklessness is final. If you stick to the framework big picture from the 4-hour, precision from the 1 hour, you reduce the odds of ruin, and that alone separates you from most. The trader who stays in the game long enough wins by endurance. Over time, something remarkable occurs. You begin to trust your own judgment, not blindly, not emotionally, but because you have evidence from consistent practice. You stop seeking confirmation from chat rooms, news headlines, or strangers shouting opinions. Your confidence grows from experience rather than hope. You become self-reliant in a field where reliance on others is the downfall of many. Trading the 4-hour and 1 hour is not a trick or a shortcut. It is a commitment to seeing clearly and acting decisively only when conditions warrant it. The simplicity is what makes it powerful. The discipline is what makes it durable. A trader who respects these two frames gains clarity in a world deliberately clouded by noise. In the end, the market remains what it always has been, a place where fortunes are made slowly and lost suddenly, a place where the unprepared donate their capital to those with patience, a place where the trend always tells the truth to anyone calm enough to read it. If you dedicate yourself to mastering these time frames, you will discover something more valuable than any indicator or secret pattern. You will learn to think independently, to take risk deliberately, and to act with confidence rooted not in certainty, but in process. This business is unforgiving, but not unfair. It pays those who wait for alignment and execute with precision. Study the 4-hour for direction. Use the 1 hour for execution. Risk little. Aim for clarity. Keep your losses small and your ambition steady. The trader who learns to do this consistently will find that the market offers all the opportunity necessary. No noise, no clutter, just price moving through time. 2 time frames. 1 process. A lifetime of trades.